The moment didn't feel like a mistake. It felt like relief. The screen was red, but not chaotic. Not crashing in a single violent drop. Just a slow, steady bleed. Numbers slipping lower hour after hour, like something quietly collapsing beneath the surface. He wasn't panicking. That's what made it dangerous, because panic is loud. Panic is obvious. But this felt controlled, thoughtful, almost intelligent. He leaned back, eyes fixed on the numbers, doing what he believed most people fail to do, thinking rationally when everyone else reacts emotionally. This isn't fear, he told himself. This is strategy. And then he clicked. So, not impulsively, not blindly, but with intention, with logic, with the quiet confidence that he was stepping out before things got worse. And instantly, something changed. The pressure disappeared. The losses stopped, at least on a screen. For the first time in days, maybe weeks, he felt in control again. Like he had outsmarted the chaos. Like he had avoided something bigger. But here's what makes this moment so unsettling. Nothing about it looked wrong. There was no alarm, no clear signal, no voice telling him, this decision will follow you for years. Because the truth is, the most expensive financial mistakes rarely feel like mistakes when you make them. They feel like solutions. And what he couldn't see, what no one could see in that moment, is that the market doesn't punish you immediately. It waits. Somewhere, just days after he sold, something small began to shift. Quietly, almost invisibly. Movements that didn't feel important unless you were still in the game. He wasn't. And that's where the real story begins. Because the damage wasn't what he avoided. It was in what he missed. If you want to understand how a single calm, logical decision can quietly reshape your entire financial future, subscribe, because this is where it gets uncomfortable. And this is what most people never see coming. It sounds simple at first, almost obvious. When the market starts falling, you protect what you have. You step aside, wait for things to stabilize, and then come back in when it feels safe again. That's the plan most people believe works. And on the surface, it makes perfect sense because losses feel real, immediate, personal, while future gains feel distant, uncertain, almost theoretical. So the mind does something very predictable. It chooses certainty over possibility. Let's break this into something concrete. Imagine two people. Both start with the same amount, $10,000. Both invest in the same market, same timing, same opportunity. But when the market drops 30%, their paths split. Person A stays. Uncomfortable, yes, watching their portfolio shrink day after day, resisting the urge to act. It feels passive. It feels wrong. But they do nothing. Person B decides to act. Not out of panic, but out of logic. They step out, preserving what's left, avoiding further loss, waiting for clarity before re-entering. At this point, person B feels smarter, safer, more in control, because they stop the bleeding. But here's where the system quietly shifts. The market doesn't send an invitation when it's about to recover. There's no message, no signal, no clear moment where everything suddenly feels safe again. Recovery begins the same way decline does. Quietly, a few green days. Small upward movements, nothing convincing, nothing certain. And that's exactly why most people stay out. Because those early recovery moments don't feel like opportunity. They feel like hesitation, like a temporary bounce before another fall. So person B waits just a little longer, just until things are clearer. But clarity in markets is expensive. And the longer they wait, the more they unknowingly distance themselves from something critical. Not just growth, but momentum. Because markets don't just recover, they accelerate. And by the time it feels safe again, something important has already happened. Something they weren't there for. Because the market doesn't reward comfort. It rewards something else entirely. The difference doesn't happen slowly. It happens in bursts. Short, unpredictable moments where the market moves faster than usual, recovering losses, rebuilding momentum, and setting the foundation for long-term growth. And here's the part most people never see coming. Those moments are rare, but they matter more than everything else combined. Let's make this real. If you had invested $10,000 and simply stayed in the market over time, letting it rise, fall, and recover, that money could grow significantly. Not because the market moves smoothly, but because it doesn't. Growth is uneven, messy, concentrated into a handful of powerful days. Now remove just a few of those days. Not years, not months, just the best 10 days in the market. Suddenly, that same investment looks completely different. The growth shrinks, the curve flattens, the future changes, quietly but permanently. And here's what makes this even more unsettling. Those best days don't happen during calm periods. They happen right after the worst one, right when fear is highest, right when most people have already stepped out. Think about that. The exact moment it feels safest to leave is often the moment that determines your entire outcome, because the market doesn't separate pain and recovery. It compresses them together. A sharp fall, followed by an equally sharp rise. Miss one, and you usually miss the other. And that's exactly what happened to him. When he sold, he didn't just avoid further losses. He also unknowingly stepped out of the very window where recovery begins. Not all of it, just enough to make a difference. And that's the dangerous part. Because missing a crash feels like protection, but missing a recovery? That's invisible. There's no notification, no alert telling you what you just lost an opportunity. Only time reveals it, years later. When two identical starting points lead to completely different endings, and the gap between them doesn't come from effort, it comes from absence, because he didn't miss the market, he missed a few days. And that's what changed everything. It didn't feel like fear. That's the part most people get wrong, because if it felt like panic, he might have questioned it. He might have paused. But this felt measured, thoughtful, even disciplined. Selling felt like control. Like stepping in when others were losing theirs. And that's where the trap begins. Because the mind doesn't like uncertainty. It doesn't like watching something fluctuate without a clear outcome. So it creates a solution that feels intelligent. I'll step out now and come back in later. Simple, clean, logical. But there's a hidden assumption buried inside that idea that you'll know when to return. Think about that. Not just when things stop falling, but when they're about to rise again with enough confidence to act. Let's pause here. Because this is where the illusion quietly takes over. The market never announces its turning point. It doesn't ring a bell. It doesn't wait for you to feel ready. In fact, it does the opposite. It begins recovering when doubt is still at its peak. So when you step out, you're not just avoiding uncertainty. You're postponing a decision that becomes harder later. Because re-entering requires something uncomfortable. It requires buying when things still feel fragile, when headlines are still negative, when your last memory of the market is loss. And most people can't do that. Not because they lack knowledge, but because they're waiting for a feeling that never comes. Safety, clarity, certainty. By the time those emotions arrive, the market has already moved. The strongest days are already behind. The opportunity that once looked risky now looks obvious, but it's no longer early. And this is where it connects back to that moment, the click, the decision that felt calm, controlled, and correct. Because what he really did wasn't just sell an asset. He stepped into a psychological loop, one that feels safe at first, but slowly pushes you further away from the very thing you're trying to protect. And by the time you realize it, the distance is already too large to recover easily. Because by the time it feels safe again, the opportunity is already gone. Years passed, not dramatically, not in a way that felt urgent or alarming. Life moved forward the way it always does, quietly, steadily, without announcing what's changing beneath the surface. And on the outside, everything looked fine. He had avoided a major crash, preserved his capital, made what felt like a responsible decision when things were uncertain. There was no obvious failure, no moment where everything fell apart. Just a subtle difference that started to grow, because while he was waiting for stability, for clarity, for the right time to return, the market had already begun moving without him. Not all at once, just a few strong days, days that didn't feel significant in isolation. Easy to ignore, easy to miss. But those were the days that mattered most, and he wasn't there. So when he finally came back, when things felt safer, more predictable, the market was already higher. The recovery was already underway. The early momentum, the most powerful phase, had already passed. He re-entered, but not where he left, at a different price, a different position, a different trajectory. Now compare that to someone who never left. Same starting point, same market, but they stayed through the discomfort, through the uncertainty, through the moments that felt hardest to endure. And over time, the difference between them didn't come from intelligence or effort. It came from continuity. One stayed connected to the full journey. The other stepped out and missed a critical piece of it. At first, the gap was small, barely noticeable, but markets compound. And so, do missed opportunities. What began as a difference of a few days slowly expanded into years of lost growth. Tens of thousands, then hundreds of thousands, quietly separating two paths that once looked identical. No dramatic mistake. No reckless decision. Just one moment that felt right. And that's what makes it so difficult to detect. Because the cost didn't show up immediately. It revealed itself over time. And by then, it wasn't just a small setback. It was a completely different future. And this is where one small decision quietly becomes something much bigger than it ever seemed. So what actually changed his future? It wasn't the crash, not the falling prices, not the red screen, not even the fear that filled that moment. It was a decision to step out of it. That single shift from staying to leaving broke something most people don't even realize they're relying on: continuity. Because long-term investing isn't built on perfect timing. It's built on presence. Being there for full cycle, the drops, the recoveries, the uncertain middle where nothing feels clear. That's where compounding does its quiet work. That's where growth actually forms. And the moment you step out, even briefly, you interrupt that process. Not dramatically, just enough. Enough to miss the days that matter. Enough to lose momentum. Enough to turn what could have been exponential growth into something far more limited. He thought he was protecting his future. But in reality, he was trading long-term freedom for short-term comfort. And that trade is almost invisible when you make it, because it doesn't feel like loss. It feels like control. But real control in investing doesn't come from reacting. It comes from staying, from accepting that uncertainty isn't a signal to exit. It's part of the system itself, a system that rewards patience, not precision, discipline, not prediction. Look back at that moment again. The screen, the decision, the click. Nothing about it seemed wrong. And that's exactly why it was. Because the most costly financial mistakes aren't loud. They don't announce themselves. They don't feel like mistakes. They feel reasonable. And that's what makes them dangerous. In the end, he didn't lose everything in a single day. He lost it slowly, quietly over time. Not because he chose the wrong investment, but because he stepped away from the process that makes investing work. And if there's one thing that separates two identical starting points into two completely different outcomes, it's this: one stayed through the uncertainty, the other tried to escape it. Because in the end, it wasn't the crash that changed his future. It was the moment he chose to step out of it.